Support and resistance levels are the backbone of technical analysis in binary options trading, providing traders with clear reference points for predicting price direction and timing high-probability entries with confidence. Support is the price zone where buyers consistently step in to prevent further decline, causing price to bounce upward. Resistance is the opposite, an area where sellers push price back down, rejecting upward movement. These levels form due to repeated market reactions, institutional order flow, psychological price zones, and liquidity pools that accumulate over time. In binary options, where precise timing is crucial, identifying these zones helps traders determine whether the market is more likely to reverse or continue its current movement within a fixed time frame. When price approaches support, traders often anticipate bullish reversals, placing call trades if other signals confirm a bounce. At resistance, put trades become favorable if the market shows signs of rejection. Strong support and resistance levels typically form at round numbers, previous highs and lows, trend lines, supply and demand zones, or areas where large candlestick wicks repeatedly appear, signaling heavy buying or selling pressure. Traders also rely on concepts like horizontal ranges, breakout zones, and retest patterns, recognizing that price rarely moves in a straight line. Rather, it oscillates between these key barriers. Breakouts occur when price pushes through support or resistance with momentum, often followed by a retest where the broken level becomes its opposite. Support becomes resistance or resistance becomes support, providing another high-probability entry point for binary options traders focused on continuation trades. False breakouts, or fakeouts, are common traps, where price briefly breaks a level only to snap back, designed to lure in impatient traders before reversing. Recognizing these patterns requires patience, candle confirmation, and volume awareness. Using support and resistance effectively means combining them with other technical tools such as RSI, moving averages, trend lines, or candlestick patterns to filter out weak signals and avoid emotional or impulsive trades. The more times a level is tested without breaking, the stronger it becomes, but the closer price gets to a level with increasing momentum, the more likely a breakout becomes, making context essential. Timeframes matter as well. Higher timeframe levels, like H1, H4, or daily, carry far more weight than those on lower timeframes, giving binary traders a more reliable structure for planning entries. Ultimately, mastering support and resistance provides a logical framework for predicting price reactions, avoiding trades during market noise, and building a consistent strategy rooted in structure rather than guesswork. In fast-paced binary options trading, where every second counts, understanding how price behaves around these levels can dramatically improve accuracy, reduce unnecessary losses, and strengthen overall discipline, turning raw chart data into a powerful decision-making system built for long-term success.